Okay. Uh, I think the U.S. rate hikes can deliver damage to emerging markets in a number of ways. First is the prospect of capital outflow. As rates rise in the United States, safer American assets start looking more attractive to global investors. So they can pull money out of emerging markets and invest it in the United States. So those shifts drive up the US dollar and push down the currencies in the developing countries. Second, the falling currencies can make it more expensive to pay for imported food and other products for the developing countries. And that is especially worrisome at a time when the supply chain bottlenecks and the war in the Ukraine have already pushed up the food and oil prices worldwide. And third, to defend the currency depreciation, the central banks in developing countries are likely to be forced to raise their own rates. Some have already started. So this could slow economic growth, increase debt burdens, and cause a tightening of financial conditions that can lead to financial crisis in the developing countries. But having said that, I think the spillovers of the US rate to emerging markets depend on the domestic conditions in the emerging markets themselves. So countries like China, India, and Korea are more likely to prove the most resilient because they generally have healthy foreign exchange reserves and low levels of external debt.
And having said that, what do you think emerging economies can do to avoid rapid depreciation of their currency and also halt capital outflows?
Sure. So I think the emerging markets should tailor their response based on their own circumstances and vulnerabilities. So the responses in general may include letting the currencies depreciate and raising the benchmark interest rates. And if the country is faced with severe fluctuations in the foreign exchange rate markets, the central banks with sufficient reserves can intervene, provided that this intervention does not disrupt the domestic macroeconomic development. Nevertheless, I think this could be a difficult time for emerging markets as they face the trade-off between supporting their domestic economic recovery and safeguarding the financial and external stability. So I think to manage these trade-offs, the emerging markets can take steps to strengthen their policy frameworks and reduce their vulnerabilities. For example, maybe a better communication of policy plans, maybe setting a credible commitment to a medium-term fiscal strategy that would all help the developing countries to face the challenges.